Well, the markets continue to melt up, and it seems like they're doing so for no particularly good reason or with particularly strong volume. Nothing especially shocking on the calendar. No big new headlines from geopolitics or from the world of economics, at least over the past 24 hours. Nothing to really suggest that we ought to be screaming higher or not. But nevertheless, the markets take their cue, and we're approaching the year-to-date highs on the major stock indexes. The U.S. dollar is lower across the board, and the markets still seem to be building out expectations that the Fed is going to end up much more dovish than expected, even most importantly by the Fed officials themselves. So what is the backdrop for all of this, and can we sustain it? That's what we're going to task ourselves with trying to understand today on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live, and we get the opportunity to get a check-in on the overall global economy here as we prepare for a update on Chinese performance early next week. We have earlier this week seen the June PMI data set for the US and the Eurozone and many of the other major economies. China is always about a week late, and next week we begin to see what they have for us for June and start to put together a more complete picture of the global growth environment. So that's exactly what we're going to do here. Look at what this data might give us and consider how it might impact the overall backdrop. Now, of course, that isn't to say that we are going to get a direct read-through from this data into the price action. It'll depend if the price action decides that it wants to care. But as ever, it is a game of relative value here and a game of watching and seeing whether assets make sense in their valuation relative to the back story and not just in isolation. So this will be a backstory shaping set of numbers and a back story shaping kind of a conversation where we'll try to figure out if the global economy really is in as good a shape as these buoyant financial markets seem to suggest. So let's begin here with what is expected. These are going to be the official PMI numbers from China. As with the U.S., there's two sets. In the U.S., we have the kind of global standard, the PMI numbers from S&P Global, and we have the Institute of Supply Management that creates a parallel survey. They pull a different set of businesses, but produce a similar thing. In China, it's somewhat similar, where you have the official numbers here from the China Federation of Logistics and Purchasing, CFLP. That's in conjunction with the National Bureau of Statistics. This is the government's PMI survey. It's tilted more so to large enterprises and state-owned enterprises, or SOEs. There's a parallel set, which we'll take a look at in just a second. That's from S&P Global in conjunction with Caixin. So we'll compare them and see what the story is. The picture here for China in these numbers clearly seems to be of ongoing standstill. So this was the reopening pop here when China finally jettisoned its zero COVID policies and reopened the economy. You can see there was a bit of a surge here. Manufacturing never really got off the ground in a meaningful way, but certainly letting people out from lockdowns was a boon for services. And so there was this services surge right here that lifted the overall economy. Since we're going to be talking about these PMIs a lot, let's just for the uninitiated, very quickly explain how these numbers work. This is a diffusion index, and so the way that this is constructed is it's tracking the services and manufacturing sector's activity growth and the pace of that growth. 50 is neutral, that is neither growth nor contraction. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the pace of growth. The further you go below 50, the faster the pace of contraction. And so clearly here we can see, following on from the manufacturing and service sector lines here, the story is of anemic manufacturing for quite some time, but then you get that pop at the reopening in services that fizzles relatively quickly, and you settle into this multi-year standstill where you now have a situation, looking at these forecasts again, where you're hugging that 50 line. So basically going back to mid-2023 and through to now, China's economy is going virtually nowhere. Here's a composite reading from that rival survey, the Caixin and S&P Global survey. And here you see it's been a little bit zestier a year back than were the official numbers, a little bit higher on these readings. But as you work your way through the past 12 months, the story is increasingly negative and increasingly converging on what the official numbers are showing, so much so that the May number was actually worse than the official figures and gave us a slip underneath 50. And when you look at the composite internals, these are those Caixin services and manufacturing numbers. You can see services, since that pop in early 2023, they've flatlined, much as the official numbers would suggest. You saw that right here. But we can see that it's really manufacturing falling off a cliff in at least these numbers in May that really gave us that very disappointing overall reading. And so when we consider then what comes next, we sort of see both of these things pointing in this kind of stagnant direction. Now, this is not entirely new or unusual given recent months, and really sort of echoes, this is why we look at PMI numbers, incidentally, it echoes in the most sort of hard data you might imagine, GDP statistics. And this is, of course, the story now for 8 consecutive quarters, speaking to the issues in the world's second largest economy. Here's that pop at the open of 2023. Since then, we can see the economy has done virtually nothing. The pace has held relatively steady and dependably sub 3% for growth, which by China's standards, we can see here, the pre-COVID levels are meaningfully stronger. But looking at what we're seeing here, the biggest issue really is that when you compare nominal and real GDP, you find that real GDP for the past 8 quarters has been growing faster than nominal. And this is the spread. You can see that when you take the difference between nominal and real GDP, you get a negative number now. Whereas you can clearly see before that, the norm was substantially pointed in the opposite direction. So when you had Chinese growth here, and it was in real terms hovering just above 6%. You're now at very similar levels here, albeit you're hovering a little bit under 6%, but the makeup of the growth is vastly different. And what this speaks to, because of course, what is nominal GDP? It is the sum of the value of all the goods and services in a country, and it doesn't factor out the impact of inflation. When you add up these things, these are sort of nominal prices without being discounted for the prices themselves going up. And so oftentimes you can get an overstated version of demand, for example, here in nominal numbers because of inflation. So you take inflation out to get a real sense of growth. Now, if real growth, that is nominal minus inflation, is running above nominal itself, then you're discounting nominal by a negative number. And that's what you're seeing here. Economy-wide deflation for 8 consecutive quarters. Now, this is, of course, horrible news for any economy, because what it essentially suggests is vast overcapacity relative to demand. So lots and lots and lots of supply, much more than demand is able to absorb. And so the entire economy is essentially on discount. The price of things is getting marked down and in economy-wide terms falling, essentially the price of GDP falling, because there's not demand to absorb all of that. And essentially what you get is an economy that for basically 2 years here has operated without demand growth. So needless to say, what we're seeing in the PMIs very much anticipates this state of affairs continuing going forward. And indeed, some of the higher frequency data we've seen recently are a case in point. At the top here, we have the latest inflation data. We can see the PPI index dependably below zero, showing us that wholesale inflation has been falling, going all the way back to COVID lockdown days here, mid-2022-ish, into the second half of the year. We flip from positive to negative and stay there. Headline consumer prices hugging zero, and have been hugging zero essentially since early 2023. The story on the external sector, hardly encouraging. There's been a little bit more pep on the export side, arguably around the front running of tariffs and U.S. demand being especially robust here at the start of the year as we get that rebuild of inventories that we saw with such sharp relief in first quarter U.S. GDP numbers. But domestic demand going the opposite direction. And that's not a happy thing when you consider that you've had anemic manufacturing for quite a while here. A short pop is not especially helpful. What you really need is for the service sector to come back to life, for domestic demand to start to take up some of this slack. And these fading import numbers, they don't suggest that that's the direction that we're heading. In fact, this is looking increasingly negative here, and the pop in exports, in fact, over the past 2 months, seems to be fading, where the front running is running its course, and we're starting to recede back. There's still a very significant pool of capital out from China. We can see here foreign direct investment still negative to the tune of double digits, but of course it has improved significantly from being worse than a 30% drop there by mid 2024. Capital is still coming out of China in droves, but the pace has, of course, improved, and was eventually going to improve even just in statistical terms as you adjust year-on-year calculations for basing them from lower levels. So eventually this pace was going to normalize, and frankly that we're in 8 consecutive quarters and of deflation, and we're only normalized to a decline of worse than 10% year on year in the latest data, still quite discouraging. Where you do see a slight sliver of positivity is in whether China's raft of stimulus measures might finally be showing a little bit of life. So we can see here, this is the Bloomberg Credit Impulse Index for China. It measures the share of new loans in GDP. Of course, China has been attempting to lay out oodles of new money to try to incentivize demand. They've cut bank reserve ratios, they've cut economy-wide interest rates, they've announced all kinds of schemes for debt relief from municipalities, for giving money to consumers for all kinds of various things, be they lower mortgage rates or incentives to buy stock or incentives to trade in old appliances for new ones at very lucrative terms. All kinds of cheap money designed to get the economy to finally start to show some life. And now that we see for the past 2 months a slight sliver of positive year-on-year growth in this index, we get the sense that, okay, maybe finally new loans are starting to perk up. Problem is that people don't seem to be wanting to spend the money. This is a view that we've been looking at here for quite a while. This is the difference between China's value of demand deposits, that is to say, those things that are there to be used almost as a checking account, so something that's earmarked for consumption now, and the difference between that and time deposits. That is to say, those things that are looking at savings, CD equivalents, and things like this for the overall economy. And so you look here, and what you see is a very significant disparity that seems to be opening up here. And the disparity really continues to grow and grow and grow here. And for the overall kind of level here, this is as high as the data available goes back. So what is this telling us? Well, maybe, in fact, yes, there are more new loans at these more lucrative terms. Maybe people are finally starting to believe somewhat that this money is really and truly available. But what they're not doing is spending it. What they're doing is increasingly sticking it in here, in savings. And so that's how you get fading imports. That's how you get still an economy that doesn't want to do much of anything growth-wise. Because it seems like consumers are not confident that growth will come back. They're not confident that the right things are being done by officials in Beijing to really kickstart this thing. They're just stuffing money under the proverbial mattress. They're taking all of this new money and they're sticking it in savings. They're not going out and spending it. And that suggests that, yes, maybe we have a little bit of hope for stimulus starting to work a bit because there's uptake of these new loans. But if the money doesn't get spent, well, we know all about that in the U.S., where we had tremendous easing in the wake of the global financial crisis, and then consumers used the money to rebuild their balance sheets and didn't spend it. And so the recovery was very, very sluggish and prolonged from the recession in 08-09 until we started to see some green shoots a little bit going into 2014, 2015, 2016. This is not dissimilar in the sense that, yes, there is cheap money. Yes, people are taking the cheap money, but they're not doing anything with it that might generate growth. The problem, of course, is that China is the second largest of the main engines of global economic output, along with the US and the Eurozone, and the story continues to be imbalanced, where the US is the only one holding up the entire situation, not just because of its share, but because of the way that it's performed. Consider also that the 42% in the rest of world part of the pie here are mainly vendor economies that depend on buying from the large three in order to have demand of their own. Here were the numbers from the Eurozone this week. Standstill, hugging 50. As we can see, this is not unusual. They've been averaging just a hair above 50 for the past 12 months. That, of course, is in contrast with the US numbers, which are a level step lower from the very buoyant 3-year highs on growth that we saw last year, but more positive. And when we compare that with the overall picture, we can very clearly see where the imbalance lies. All of the second half of last year, it was China and the Eurozone at standstill, and the US powering ahead. The wedge has narrowed, but nevertheless, it is still the same story. Standstill in China, standstill in the Eurozone, and more modest but still positive growth in the US. That would be all well and good, except as we look at the way that U.S. economic data is increasingly performing relative to forecasts, we can see that of the major economic engines and groupings here, it is clearly the U.S. where data is underperforming, today's buoyant durable goods data notwithstanding. Emerging markets, relatively steady. Eurozone actually improving. The overall global economic data surprise index fading, suggesting that global data flow is cooling. That's clearly coming from the G10 space, of which the Eurozone is not the issue. Clearly, it is the US that's pulling the situation lower. And so, for the global economy as a whole, we are left with an ominous backstory. This is the only part that's working, and it's also the one that's deteriorating. This is already at standstill, and this will probably remain so when we get this PMI update next week. Now, will the markets care, and will they start to turn to a more risk-off direction on this basis? As ever, we'll have to watch the price action to see. But if something does occur to spook investors, the backdrop is certainly anything but cheery. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow. I'll be back with Chris for Futures Power Hour tomorrow. We'll also be covering for Tom and Tony on Last Call, so you'll see a bunch of us as a special case this week. I'm likewise on The Price of Truth with Victor Jones on Tuesdays, with him and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter. and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.